Well, hello everyone. It's Brandon from Orange Brick Road. Yep. Welcome to everyone that's joined us, whether new or just our clients. Hi everyone. Today we've got Jamie from Nexus Reporting, just going through a presentation on the tax planning. With crypto, sort of minimizing your tax. Hopefully, getting to the point where you pay no tax because taxation is theft. That's just my opinion. Yeah, okay, just a brief history of Jamie. We've been working with Jamie for some time now. I can't remember how long. It's been a while, hasn't it, brother? And when I first met him, he's like, oh, I can do it from different wallets and da was staking. And I said, dude, well, if you can do mine, you can do anyone's because I'm on 12, 14, 16 different exchanges. I've got 15, 20 different wallets. I've done liquidity providing, staking, whether it's through protocols like Hex or on Uniswap V1, V2, also staking with other stuff. I've bought, sold, over the 6, 7 year period, and I haven't kept a scrap of paperwork. So if you can sort me out, you can pretty much sort anyone. So I went, go for it, mate. So then he's come back 2 to 3 weeks later with this comprehensive report, and he'd done everything. So yeah, like if he can do mine, peeps, he can do anyone. Yeah, too easy. Pete's. Hi guys, thanks for having me. Mutual friend of mine, Jamie's Mike. Let me in. All right, too easy. Uh, okay, I don't know what I just did then, but all right. All right, too easy. So, anyways, I'll stop being distracted. This is going out on our next week's newsletter, so you guys will be getting that. Also, might be turning this into a podcast. Well, actually, we've done a radio. I had Jamie on my radio show, Crypto Hour of Power on Edge Radio, which will be coming out in a podcast next week. But once again, if you're seeing this on Facebook, YouTube, Twitter, LinkedIn, or whatever, yeah, just get hold of us. Get hold of Jamie. He's going to have the details at the end, obviously. I know that Jamie might look like a little pup, but he's extremely knowledgeable in crypto. He's been in it as long as I have. And yeah, so we'll leave it at that. And also, if you guys are getting this, Jamie will be joining me for our newsletter at 4 o'clock this afternoon. Orangebrickroad.com.au. We have newsletters, free ebooks, free courses, have consultants, the whole 9 yards. So that's enough plug out of me. Over to you, James. I've shielded enough.
Yeah, thank you, Brandon. That was pretty much the best intro I've had yet, I reckon.
Cool.
Cheers. So pretty much today, that's really well explained what the whole thing that we'll be talking about is. So there's a couple months until end of financial year, which means basically now's the time when you can go through what's happened for the entire year and work out where you're sitting and then how you can make that better for you. So pretty similar in vein to Brandon is one of my own favorite quotes from me, which is the ATO only wins if you let them. If you're being complacent, you're just waiting until the end of financial year and paying whatever you have to pay, that's not actually beneficial to you at all. What you should be doing is actively working out where you are, working out what your position is, and then how you can make that better for yourself before you hit 30th of June. So this presentation is for you if you own cryptocurrencies, which I assume everyone listening would. That's pretty much the whole channel. And then as well as that, if you've had a taxable event during the financial year, so selling crypto, staking, liquidity pools, anything like that, there's so many that they're all treated a little bit differently. So if you've been in there, this is important for you, as well as if you're unsure of the tax consequences. So do you know what the tax consequences of staking HEX are when you pull out the HEX? What happens if you put in the HEX? Is there an event there? And then also, if you have a need to clearly report on all of that, so say you have a trust that you need the holdings at the end of the year as well as the profits, or even more strict, like a self-managed super fund, if you have that, you need a clear report that auditors can see and be happy with. And then if you want to maximize returns that you have during the year and have the chance to minimize those taxes, that's important as well. So basically the first section will just be an overview of tax reporting, why it's important, how it can be done, and the different options that you have. So crypto reporting, it needs to be done each year. You can do it lots of different ways, but it does need to be done for your tax returns. So the ATOs actually pretty recently as well said they've come out with increased data matching capabilities. So different exchanges KYC, different exchanges might give them your actual trades, what you're doing, as well as if you're sending money in from wallets to their exchange, all of that's being provided to the ATO. So they can basically say, you haven't reported anything, but we know that you have crypto. And then ignoring or deliberately omitting that, it'll lead to pretty much big fines, big issues, and just not fun. So, as well as that, the reporting has to be done each year. If you retroactively go back, report 4 years of big capital losses, and then this year you have a big capital gain, which is offset, it's going to raise red flags at the ATO. And then 90% of accountants that I've spoken to have no idea what crypto is, they have no idea what to do, and they have no idea how it's actually taxed. So that's pretty well leads into what I call the crypto accounting brick wall, which is you going to an accountant saying you have crypto and then having to teach them what crypto is. So I used to be a tax accountant. I've been there and I've seen firsthand how some people, some accountants you talk at, they're just nothing absorbs. It's in one ear, out the other because it's crypto. They don't want to hear about it. So I know the stress that people go through when basically you're trying to explain crypto to them. And I've also seen the stresses people go through doing it yourself with online calculators like Coinly or Crypto Tax Calc. They're cheaper, but you're paying with your time effectively because the issues that you run into are just basically they compound on each other. So getting a report done by someone like us and taking that report to an accountant can effectively turn any accountant into a crypto specialist without that exorbitant cost of the ones that are out there at the moment. So all they do, there we go. So accountants themselves, they deal with the tax legislation, how to apply the tax legislation. They don't really deal with data analysis. You take numbers to them and then they'll work with those numbers. So into those online calculators, which are a popular choice just because of how easily accessible they are, you're pretty much, if your data isn't perfect, you're going to end up paying more tax. So if the data doesn't have a cost base because you've forgotten a wallet, you've forgotten an exchange somewhere, all of the online calculators, they'll attribute that as a 100% profit sale. So you bought one Bitcoin and you sell one Bitcoin, but it doesn't know that you've bought it. So you're paying, say, 90 grand in gains because it can't find that cost base. So then that you pay too much tax. And then fixing the errors. So it can't find something, it'll put up an error, it'll still calculate it as a gain, but you fix one error and it'll give rise to another one because that root issue hasn't been caused. Everything's automated to say, this is all the information, let's trust it and go with that, as opposed to having a person do the reports where I could see you're missing this. I can look on, say, Etherscan, see that you've had funds sent in from Binance, but you never gave me a Binance account. So I can work with you to effectively get that information correct. So there's no assumptions in there. And then fringe activities. So NFTs, so ERCs and 1155s, all of those different new fringe activities. So sacrificing most things on Pulse, they're all generally just treated as 100% profit because they're categorized wrong. There might be sales when actually they're just transfers across. So without, I guess, a supercomputer that's incredibly smart, the automated systems will struggle with how much new, I guess, crypto activities there are at the moment. And then for people that choose to use online calculators, so you have pretty simple crypto, you use one or two exchanges and that's it. A few of the common issues, which I think it's important for everyone to actually know about, is, so the biggest one is Binance. It takes 3 hours to get data in, there'll be data missing. If you're using Binance, always use an API and then cross-check it with a CSV, and then also make sure that beyond 3 months, it's still reporting things correctly, because that's basically the biggest issue that people run into without actually knowing why. As well as that, you have CoinSpot income will only report to 3 months, and then missing cost bases all the time. So check through manually and make sure that if you are using these, you know exactly where your crypto's come from, where it's gone to, and then also how it should be treated. So then more common recently over the last couple of years is sacrifices is going to be 100% manual. If you're doing your own reporting, be aware of your transactions that are sacrifices, and you'll have to change those values yourself. Otherwise, it'll just be a withdrawal. And then finally is the wrong crypto. So it makes my job a lot harder as well. I run into this is one exchange will list something just as Solana, SOL is the code. Another exchange, SOL2. Another exchange might be something different. You have to know which of these are right, which are wrong, and then how they actually match up together. Otherwise, you're going to have three different assets all for the one, and you'll be confusing the cost bases. Those seeing, because a lot of people do use online calculators, I would say these are the biggest things to look out for. So basically write it down. If you have any of these, just pay more attention to it. So tax planning. So before the end of financial year, instead of waiting until the year's done, you can do a bit of tax planning beforehand. So what actually is tax planning? So if you know where you are right now, you can change where you'll be in the future at the end of financial year. If you know that currently you're sitting on a big profit, but a lot of your coins are in a loss, you don't want them in your portfolio anymore, you can change that big profit you're sitting on by basically crystallizing those losses and selling it. Generally, it'll be done 1 to 2 months before the end of financial year, and it's for you to work out how much tax you'll be paying at that point. So it can be just crypto, or you could be with an accountant and working through your entire financial tax return. And then basically, yeah, you work out what you can do to minimize the tax and make, when it comes to end of financial year, beneficial to you, not the ATO, which is the big point of this entire presentation. So then basically the tax planning in crypto. So what we'll do for that, we work through your year to date in crypto. So from 1st of June to now, basically what's your net capital gain or losses, all of that. What's your income? And then the biggest one is unrealized gains. So in the report themselves, we say, this is your portfolio, this is what you're holding. But if you were to sell this now, you'd be able to claim $200 in losses. You'd be able to, I guess, realize a gain here. That's the big benefit, is you get the chance to mold your end of financial year position. So everything that's happened until now you can't change, but you can do things to change that final result. So yeah, crystallize your losses, realize gains, and then if you are working with an accountant, they'll have your income, they'll have dividends, interest, anything like that. And you could realize gains basically perfectly to the top of your tax bracket, taking into account deductions. So say you only wanted to pay 30%, you push yourself right to the top of that and you don't go above it. That's sort of the power of tax planning. So for an example, in the reports, this is just a sample. And say you're sitting there with a $200 gain, you don't really want the WePower as part of your portfolio anymore. You've forgotten about it, or you've just sort of pushed to the side and you don't think about it. You could have sold all of that and sat on $0 of gains. You're not paying any tax for the year, and you've been able to clean up your portfolio. So it's those benefits are the biggest things. And then just one more reminder as well is that crypto itself is only like a single part of your tax puzzle. You've got all your other sources of income, you've got deductions, you've got all the different tax offsets that you might be available to you. So you've got all of those. They all affect your tax payable or tax refund at the end of the year. So I'd say it is very important with tax planning to work with an accountant or someone who has that whole picture. So a family accountant, even if they might not be very well versed on crypto, with a report like this, you can basically tell them, this is my position, and they can understand it straight away. So what happens is you provide accountants with your numbers and they apply it. They plug that into a tax return, they hit submit, that's it. But taking a step back from that is we work together to basically make those numbers that they'll use. We work together to see what's beneficial for you and how do we do it. So Yeah, I did promise that I'd go through all of it pretty quickly, leave time open for the questions itself, because I can talk at you for hours on this. You will fall asleep, but it's one of those things where people have specific questions. They're your situation, your specific areas that you're interested in. So it could be staking, it could be liquidity pools, everything like that. And unless you get to ask those questions, it's not really going to be that helpful that I just keep talking at you. So yeah, pretty much now is if you do have any just open questions at all, let me know. You can put them in chat, or I think you might be able to unmute yourself and ask, and I can go through those with general advice, not specific, and no investment advice either.
Yeah, thanks, Jamie. No worries. I think Pete's unmuted. Josh, you're still muted, but you might be because you're at a family function. All right. Anyways, Pete, you got anything, mate?
Yeah, g'day guys. Thanks for that, Jamie. Look, it's super basic. There's not a lot that I do with my crypto at the moment. I've got a wallet. I have a few on the exchange, which I've left for probably over 12 months now.
Yep.
Is there anything I need to be doing with yourself to prepare for this tax, even though I'm not really touching it?
So if you haven't sold anything, I'd say that sort of sounds like you haven't really done any of the more fringe activities on the chains. So if you haven't sold anything, it's basically, I'd say there's nothing that you do need to do because there would be no taxable events. If you're just holding it, it's only taxable when you sell it, and transferring it between an exchange and a wallet isn't actually taxable. So it's just sort of moving where you're holding it.
Have you staked any coins on that exchange, Pete?
Look, I might even have to go back and have a look. It's been a while since I've been into the exchange, but that's a good question. So, if I have, then what should I be doing?
So if you've staked anything on the actual exchange, is it CoinSpot you've used or a different one?
What's it called? SwiftX.
SwiftX, yep. So if you have staked
Yeah.
anything on the exchange, but you haven't done any sales, pretty much what I would say for you to do is it's not worth getting a report or anything done because it's already been staked. You'll be able to effectively just download your history of staking rewards, add that up, and then that will be the income that you have to report for the year. So there wouldn't be any capital gains side of things income, which with staking of that generally comes as just other income in a tax return.
So the staking
Cool. Thank
rewards
you
are
for that.
not unrealized gains. They fall in the category of income. Is that right?
So staking rewards do. Unrealized gains don't get taxed. That's sort of a tool that you can use to see where your portfolio is sitting, so what profits. And then after that is whether you want to sell it. So you've got staking rewards, liquidity pool rewards, and if you have any like referral bonuses, those are all income. Whereas sales, so that would be capital gains. And then from there, past that, you get into more convoluted things.
Okay. Josh?
Yep. So am I right to read that um, uh, farming with liquidity providing are taxable events and the generation of, let's say, tokens becomes a taxable event at the time of creation or of withdrawal or restaking? How does that work?
So it depends on the actual liquidity pool that you're using, which is where things get a bit more fun. So
Okay.
the general principle that I use, which is sort of mirrors the way the ATO has said things to make it, I guess, as simple as they can, is generally, so with the most standard pools, as you provide liquidity, you're selling that crypto and purchasing a liquidity pool token. And then when you basically sell that liquidity pool token and remove your liquidity, you're buying those tokens back, as well as the amounts that are extra that you generate is income in that sense. But then again, it depends on whether there's that third party involved in the actual liquidity pool, is it just being tied up in a contract, or is it actually going to another wallet? Is sort of the more complex things you have to look into with each activity. But that is, yeah, generally that is the way that it's seen, is you're selling your crypto, buying a liquidity pool token, then you're selling the liquidity pool token, buying your crypto, and you have a reward.
Right. Okay. So I am liquidity provider for Pulse X, Hex, and the ink tokens that are generated, I then use that
Yeah.
to reinvest and to become a liquidity provider. So am I right to take it that every time I withdraw that and then restake it, they're separate taxable events?
Yeah. So if you're withdrawing and restaking though, it is a separate taxable event, but the time that you're doing that is almost instant. So there's not really a price change between when you're buying and when you're selling. So it is a taxable event, but in that case, there's no taxable outcome from that because the prices are the same.
Okay, so to make these calculations for reporting purposes of all of this, I mean, it uses the PulseX app. Is there an easy way other than manually calculating it? Is there a program, or can it be done on the Pulse
So
setup or not?
yeah, so Pulse itself, so basically so like my system does all those calculations, as well as I think the online ones try to do them. But the biggest issue at the moment is Pulse has, how do I put it easily? How do I put it nicely is how I should put it. They basically don't have an explorer. And when you're pulling information from Pulse, there's missing transactions everywhere. So a lot of it is ending up to be manual. So basically, the biggest example is if you start looking at an address on Pulse that someone had sacrificed crypto for, they got their big airdrop of Pulse and Pulse X, but the Pulse X shows up whenever you're pulling data from there, but the actual airdrop of Pulse doesn't. It doesn't exist unless you're looking through token balances to find manually when it was airdropped. So I guess Pulse itself brings in quite a lot of extra complexities, which if you were to use an online calculator, you would generally have to do it manually with changing transactions.
Okay.
So the Pulse Chain Explorer, you can't just put your address in there and then it'll just have every transaction. Is that what you're saying?
You can, but when you look at your transactions, generally for some addresses, but not others, which is the interesting thing, that the airdrop of basically the initial airdrop of Pulse from sacrificing, there's no transaction for that unless you look at coin balances and see there was a big spike in that's when you were holding Pulse is when the airdrop was. But then also you have to take into account that as Pulse was basically a hard fork or a clone of Ethereum, it's bringing in transactions from before you actually had access to that wallet. So Pulse, the launch about, what is it, around the 12th of May last year. But you'll see there's transactions going all the way back 2 years, 3 years, which if you were to pull all those transactions in, you would be paying tax on those doubly because you've already done that on Ethereum. Whereas those should effectively be deleted and then just counted as an airdrop. But that's sort of one of those things I was talking about with as things get more complex and there's more new activities that are happening, there's basically a lot of software that struggles to keep up with that because it's made, say, a few years ago, set and forget, and then it just goes from there. Whereas crypto is always changing, so you need those updates.
Yeah, I'm just on Pulse Scan at the moment and I can't see any of my sacrifice.
So I generally use what is it, the scan dot 9mm. And from using that, you can go through and they have a section called coin balance history for whichever wallet you're using. And then in there, you'll just see that there's a spike in holdings of Pulse with no associated transactions, that's when the actual airdrop was.
So what was that scan dot?
So it's 9mm, I think is what they call it. So scan.9mm.pro is the one that I've been using,
Okay.
just to sort of look in there.
All right. Well, I've got a couple of things if nobody else has anything at this stage. No, all good. All right. You've done all my sacrifices with the report you did with me, yeah?
Yeah.
Okay, cool. What about when you said referral incomes, like so if you're getting referrals of different exchanges or whatever, that's classed as income, yeah?
Yeah, so that's basically income. And then also when you receive it, so say it's $10 of Bitcoin from somewhere,
Mm.
you've got that $10 that you're reporting as income, and then that $10 becomes the cost base for when you sell it eventually.
Okay. Yeah, cool. And now when you say income, you mean like as a wage? Yeah.
Yeah. So
Okay.
in a tax return, you have basically two accounts, right? There's your income account, which is salary, it's dividends, interest, or you have your capital account. So that's shares, crypto, property. So capital assets, their profit and loss is separate from income. So just
Okay.
another way that the ATO wins is you can use basically, so say you have 50 grand of salary, that's your income. So you're paying tax on 50 grand and you've made 20 grand in crypto, you'll be paying tax on 70 grand because they're added together, right? But if you made a 20 grand loss in crypto, they won't let you take that off your income. So they'll tax you if you make a profit, but they won't take it off income if you made a loss. You have to make a capital profit to use those losses.
Oh, that sounds just about par for course when it comes to the government, doesn't it? That's fucking unreal. All right, what about scams? You say you've been scammed from someone,
Yeah.
or you sent your assets to the wrong address, which
Mhm.
I've done, people do. You can claim that as a loss on your income or your capital gains.
So with that, it would be your capital side of things. And if you've been lost or scammed, basically it's as if you sold that crypto for $0. So you bought one Bitcoin for 10 grand,
Yeah.
then got scammed, lost that. It would be the same as you selling that Bitcoin for nothing. So you have a $10,000 loss in
Okay.
your capital account.
Okay. Yeah, cool. All right. Then the last thing, is the setting yourself up. I mean, like, a lot of people do it retrospectively, because they jump into crypto because they see, some moon boy on YouTube, and they first get involved in it, and then a year or two later, then they consider, oh shit, I should have put it through my super, or I should have put it into a trust, or I should have put it through a business. Can I mean, ideally, the best thing is to speak to someone like you, and you would assess, okay, what's your income, what's your outlook, what's your investment, what's your time frame, et cetera, et cetera. Okay, maybe you should put it through a trust or a business entity or something like that and set them up. That's in the ideal scenario. But can you retrospectively do it? Like, for example, myself, as an example, go, okay, let's turn the clock back. I'm pretty sure I know the answer to this question. To turn the clock back 7 years and go, all right, let's make this a trust now.
Yeah, in short, no, basically.
Oh,
It's you'll have to set the trust up as a separate entity and then do everything. So you'd be, say you did it now, you'd have to set up the trust as an entity. You'd then have to sell all of your crypto by giving it to the trust, and then you'd be paying tax on that, and then it would be in the trust. So you can't go back and say because the entity didn't actually exist then. But also, I would say don't speak to me about that sort of thing. So I'm not a practicing accountant anymore. That'd be, so if you weren't an accountant, so that'd be like Kayleen through
yeah.
Orange Brick Road. Yeah. So they've done mine. So yeah, I don't do that. They do the actual structuring and all of that side of things.
Yeah, Kayleen Moore Wealth. She's on the
Yeah.
website on tax, which you'll be there soon. You should have been there last week. Yeah, she's great. And also, I mean, obviously, it's setting people up through this, using their super for crypto is a thing now. I mean,
Mhm.
we've put 12, 15, 16 people through in the last few months.
Yeah.
that is a really good way of like, is there any tax advantages of doing that?
So it's similar to just general super. So if you're investing or you're putting contributions into your super, that's taxed at say like 15% on the way in, but then any gains you make in there wouldn't be taxed effectively. There's super's like very complicated when it comes to the accounting side of things, but the very short way to explain the benefits is less tax, but you can't access that money until you're 60, 65, whatever they decide the super age is going to be. So a lot of people have money in super and they want to invest in crypto in their super, but you have to set up a self-managed fund for that because there'll be no funds out there willing to take on that risk. So if you had money that you wanted to invest in crypto that's in super, you'll have to set up a self-managed fund. So that comes with its costs. But in a tax sense, there are benefits there if you're happy for your money to be not accessible for the next 40 years, in my case, or depending.
Yeah, like about 4.5, 5 years in Josh's case. Anyways, okay, but see, with your super, you can only put a proportion of your super into crypto. Is that right? You can't put all of it.
It depends on, so when you set up a self-managed super fund, there's a whole bunch of like the constitution, you have to have effectively your how risk adverse you want to be, your trading plan, all of that set up.
Mm.
So if you were to say, I'm happy to take on risks such as crypto, you put all of your money into the super fund, and then that can trade however it likes within the crypto space.
Okay.
So you might have, so like Australian super or all of those different ones, you could have money in there, which you put across to your self-managed fund. And then from there, it depends on the constitution of when that fund was set up, which generally, if you're doing this, it'll be set up to say, can take as much risk as I want, but there are stricter guidelines around it.
Right, but hypothetically, say for example, you've got 100 grand in super, right? And you've got 15, 20 years before you can withdraw it out. That 100 grand with inflation is probably going to be worth about 30 grand worth of purchasing power within 15 to 20 years. Yeah.
Mhm.
But if you put 100 grand into Bitcoin at the moment,
Yeah.
it's probably going to be worth more than 30%
Mhm.
of purchasing power.
Yeah.
Not financial advice, but that seems like, the sun's going to come up tomorrow logic,
Yeah.
But
So
then you'll be taking the risk on, okay, is Bitcoin going to be around in the next 10 or 15 years?
mhm.
But can you at some stage, say you're 7 years into it and you decide, okay, I want to switch this over now. I don't want to have a self-managed super. I want to pull out my profits and then transfer that over into an actual super account. Can you do that?
So, as far as I'm aware, you can do that. So, you'd basically be wrapping up that super fund by putting it into another one. But I guess the big thing that people sort of need to understand when it comes to self-managed funds is everything to do with it is quite expensive. The setup is quite expensive through accountants, lawyers, everything like that.
Yeah.
When you're trading in there, it's the same as just trading normally. But at the end of each financial year, you'll need all of your accounts set up. Only some accountants do self-managed funds, and then you'll need the backing in there. So every year, your self-managed fund will get audited to make sure that you're doing everything that you're supposed to be,
Yeah.
which generally any super fund that I've done, they've used my report and the auditors ticked off on it. But if you were to use an online one, you're sort of running a bit of risk.
Yeah.
So you're paying basically audit fees and accounting fees every year. And then when it comes to wrapping that up as well, it would be quite expensive just because it's such a complex area. It's not highly competitive when it comes to accountants and lawyers.
Yeah, but just say hypothetically run through this scenario, and we will tie up soon because we don't want it to go run too long. But while I've got you here, just say hypothetically you had 100 grand in super and you put it into Bitcoin, and then that 100 grand turned into 250, 300 grand within 18 months to 2 years, which all probability it could, most likely will. That $200,000 that you would be paying capital gains on, instead, because you won't be paying capital gains on that because it's with the super, will well and truly offset any cost it would take to set up. So the 4 or 5 grand to set up.
Yeah.
Yeah. So the bonus is one, you're not paying the capital gains, especially under like the tier system with the first year or two. because obviously that's a higher capital gains rate, the profit would be offset by the setup itself. Yeah.
So yeah, I definitely am not a specialist in managed super funds. I know like the base level, what they do, why they're set up, and roughly how. But when it comes to all of that sort of like complex scenario forecasting, again, I'd say speak to Kayleen from More Wealth. They do that pretty much every day. And if someone asks me, I'd send it to them.
Yeah.
But in general, yes, investments, you pay tax on the way in, and then that's about where it happens.
All right, excellent, man. Thank you very much for your time, Josh, or anybody. If you've got any more questions, speak now or forever hold your peace. I'm going to count. I've got a ticking clock. You know what reference that is from? Team America. Okay, brilliant. All right, thanks, guys. Well, anyway, to finish off, Jamie, how do people get hold of you? Do you sure, mate?
Yeah, perfect. So if it is something that interests you and you do want basically to talk about just crypto in general, want to learn more about the tax side of things, or actually get the reports done, so tax planning reports, end of financial year reports, or even have some clients who they are full-time day traders and they want monthly reports, I'll do that so they know how they're going, what's in profit, what's not. Best way to get in contact is through my website, so nexusreporting.com.au, or just send me an email, jamie@nexusreporting.com.au, and organize a chat.
Beautiful. All right, and one last, Jill, just because this is going out in the newsletter and all that sort of jazz, you can also find. Can you see my screen, guys?
Sharing.
Can you see my screen? No.
Yeah, can now.
All right, happy days. Jamie is also under services here, under consultants. He will be under tax. That should have been done last week, but anyway, under consultants. It's at orangeroad.com.au. There's Jamie, so you can get hold of him through. There he is. There he is. All right, and there's his partner in crime, Jaxa, Jeremy. All right, so yeah, we'll leave it at that. I'll stop sharing now. Okay, well, thanks very much for your time, mate. And I'll send that out next week's newsletter, and obviously the radio interview will be coming out as well.
That sounds good. And if you guys have any other questions, just feel free to basically send me an email and I can answer them there.
Brilliant. All right, guys, no worries. I'll give you a call soon. Because we're doing our live stream at 4, aren't we?
Yes.
I don't need to prepare for that. I haven't done any homework yet.
Yeah.
All right, guys. Get in touch with Jamie. Have
See
any
ya.
questions, reach out. Thanks, guys.
Great, thank you.
Nice one. Thanks, boys.